Hello students. Today we are going to learn chapter 9 of business finance. So what is meant by business finance? Let's understand the basic concepts first. Money which is required for carrying out all the business activities is called business finance. For any business to start or in order to survive any production or any business, we need money or finance. So, finance is needed to not only establish a business and not only to run it, but also to modernize it, expand it, or diversify it. So, in short, for every activity and function in an organization or business, we need finance, money. So, finance is central to running day to day operations of business like buying, supplying, paying bills, salaries, collecting cash from customers, etc. So, finance is needed at every stage in life of business entity. And availability of these finance is very crucial for the survival and growth of business. Now, when we talk about financial management, which is again very, very important, financial management is concerned with optimal procurement as well as usage of finance. The finance so produced needs to be invested in such a manner that return from these investment exceeds the cost which procurement has taken place. So in short, for any amount of finance which we are investing, every firm would look out for more profit out of it. And every firm would try to have minimum cost of production so that they can earn more or maximum profit. Nextly, financial management also aims at reducing the cost of funds, that is cost of production, and keep the risk under control so that they can achieve effective deployment of fund. Now let's understand what are the objectives of these. Primary aim of financial management is to maximize shareholders' wealth, which is referred to as wealth maximization. Now, this is because a company fund belongs to shareholder and the manner in which they are invested and return earned by them determines that market value or price. So when any company is earning more profit, their market standing or credit worthiness is more. Now, market price of equity share increases if it benefits from a decision exceeds the cost involved. And all the financial decision aim at ensuring that each decision is efficient and adds some value. So, a person who's going to be a decision maker or the management who takes the decision about investment into any of new machines or assets, the aim of financial management is to ensure that benefits from these investment exceeds the cost, which means that they earn more profit as compared to cost. Now, in all financial decision, major or minor, the main objective that guides the decision maker is some value addition. So every decision maker would try to add value and gain more. Now, when we talk about financial decision making is concerned with three broad decisions like investment decision, financing decision, and dividend decision. Now let's learn one by one all the kinds of decisions which are related to finance. Now, investment decision means a firm's resources are scarce in comparison to the use to which they can be put. We know very well that the demand is unlimited, the wants are unlimited, but the resources are in scarce. And a firm has to choose where to invest these resources so that they are able to earn highest possible return. So it becomes very important that the investment decision has to be apt. It relates to how the firm's funds are invested in the different assets. Now, when we talk about investment decision, it can be either long term or it can be short term. A long term investment decision is also called as capital budgeting decision, and it involves committing the finance on long term basis. For example, making investment in new machines to replace an existing one, or acquiring a new fixed asset, or opening a new branch. So these decisions are very crucial for any business since they affect its earning capacity over the long run. Now, long-term decisions or long-term investment decision, these are the decisions which normally involve huge amount of investment. Like, let's say, for example, these are the expenses or investment decisions which are irreversible except at a huge cost. And once you have made this decision, it is sometimes or most of the time it is impossible for a business to wriggle out such decision. So they need to be taken with utmost care, and these decisions must be taken by those who understands them properly or comprehensively. Now, these short-term decisions are also called as working capital decisions, and they are concerned with decision about the level of cash, inventories, and debtors. And these decisions affect the day-to-day working of business. These affect the liquidity as well as the profitability of the business, like efficient cash management, inventory management, and receivables management are some of the essential ingredient of sound working capital management. So this was all about short-term and long-term investment decision. Now talking about factors which affect the capital budgeting decision. Firstly, it is cash flow of the project. Now, when company takes an investment decision involving huge amount, it expects to generate cash flow over a period of time. And the amount of these cash flow should be carefully analyzed before considering a capital budgeting decision. The second factor which may affect capital budgeting decision is rate of return. The most important criteria is the rate of return. So these calculations are based on expected returns from each proposal. And the investment criteria which is involved also is one of the factor. So the decision to invest in particular project, it involves number of calculations regarding the amount of investment, interest rate, cash flow, rate of return, etc. Again, when we talk about financing decision, which is a second decision, as I explained you that there are three, as we saw it over here, that financial decisions are first investment decision, which we have already discussed. Second is financing decision. And the third one is dividend decision. So moving on to second one, which is financing decision. This decision is about the quantum of finance to be raised from various long-term sources. Now, when we say long-term sources, it could be either shareholders fund or borrowed funds. Shareholders funds are those wherein equity capital and retained earnings are involved. And borrowed fund refers to finance raised as debenture or other forms of debt. Now, interest borrowed fund have to be paid regardless of whether or not in the firm has made profit or not. And these borrowed funds have to be repaid at fixed time. So the risk of default on the payment is known as financial risk, which has to be considered by a firm likely to have insufficient shareholders to make these payments. Whereas shareholders fund, on the other hand, they involve no commitment regarding payment of returns or repayment of capital. So A firm should be very careful while taking such decisions which are related to financing. Now, there are certain factors which affect financing decisions, like the cost which is going to be incurred, the amount of risk which is involved, flotation cost, cash flow position of the business, and the level of fixed operating costs which are going to be occurred by the business, irrespective of whether they are going to earn profit or not. There are also certain control consideration and state of capital market which would affect your financial decisions. Now, moving on to the dividend decisions, the third important decision that every financial manager has to take relates to distribution of dividend. And dividend is that portion of profit which is distributed to shareholders. So these decision involved here is how much of the profit earned by company, that is after paying tax, is to be distributed to shareholders. Now the factors which would affect the decision makings are earnings, that how much a company is earning, the stability of earning, stability of dividends, growth opportunities, cash flow position, how is the taxation policy, and what is the preference of the shareholders. And even the stock market reaction or legal constraint are the factors which would affect the dividend decisions. Thank you.